Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Sean Brodrick, editor of Wealth Megatrends, also contributing analyst to Weiss Ratings Daily. Sean, big picture outlook, kind of timing with the Fed meeting last week and the dot plot outline of three rate cuts for this year. We were talking to you off mic, and you're seeing this environment of a generally easier Fed when these rate cuts come as being an even further catalyst for these markets. It's been interesting to see. Didn't seem to matter where rate cut expectations were. Markets just kept plowing higher, especially after that October low. Sean, how do you see this big picture environment for, again, a wide range of sectors that could benefit from when the Fed actually starts cutting?
I think the upcoming Fed cuts, the anticipation of those cuts is actually quite bullish for the market. And that's not the only thing, but it is bullish for things like commodities. Generally, when interest rates go higher, commodities go down because commodities don't pay interest. So as interest rates come down, commodities generally tend to go higher. So that's bullish for all sorts of stuff: gold, silver, oil, copper. I mean, these are the things that should probably do quite well in that environment. Plus, as interest rates come down, that should unleash the housing sector. There are so many people that are priced out of homes now. And so, what happens when we see housing start to turn up? Not only do like wood sales go up, but also steel. And also, if you are building more homes, you need all the appliances for those homes. You need paint for those homes. You need everything. And so that's just bullish all around. So I expect that we will see three rate cuts this year. I mean, that seems to be what the Fed is waiting for. It's been so long, and we've had so much disappointment. There are plenty of people on Wall Street that don't believe the Fed now. I mean, I hear these people talk on the TV. They don't think we're going to have any rate cuts. I think those are people talking themselves into doomerism, and they can't see what the Fed is trying to do. And I do believe rates are coming down, and that's one of the factors that will give us a quite bullish 2024, or I should say the rest of 2024.
Well, Sean, you mentioned the rates coming down would be bullish for the commodity sector. Let's maybe start off with the metals. You mentioned that you're liking gold, silver, and copper. What about the equities? They've had nice moves, the metals, but how are you playing the equities right now in the metals?
Nothing's disappointing me more right now than gold stocks. I have to say that because I own some, and they're doing okay, but they could do a lot better, especially when you look how gold has moved since the beginning of March. We haven't seen the corresponding move in the equities. Now, a lot of that has to do with a whole bunch of companies are still issuing shares. That seems questionable to shareholders and certainly dilutes the cash flow per share, which is very important. But I think it's a lack of optimism in the market. It's just that investors don't believe the gold rally will last. I think they're wrong. We're seeing the same thing in the oil markets. I mean, oil equities have rallied, but they haven't rallied nearly as much as you might think they would have, considering where oil prices are now, around 82 bucks a barrel. I mean, there are many companies over the past year and a half. We've seen plenty of these companies just cut out the fat, get down to owning only acreage where they make a lot of money, even at much lower oil prices, because that's a good survival strategy. Now they're going to make a lot more. And so I think oil stocks should do very well if we can convince Wall Street that the rally in these commodities is real. My target on oil is 90 bucks a barrel. There's a lot of companies, including smaller oil companies, that can do very well in that environment and on a trip to there. And I'll get back to gold in a minute, but I just want to touch on something. I know people are bearish on oil, and believe me, there's a chunk of Wall Street that's like this too, because U.S. oil production is ramping up. I think it's something like 13.3 million barrels per day. Macquarie just said that by the end of the year, America will be pumping 14.5 million barrels per day. And when you have more supply of something, prices generally go down. The thing is, it's a global oil market, right? And so the oil we pump here in America can be sold all around the world. U.S. oil exports are just rising. Part of that is due to rising global oil demand. Consensus is for an extra, it's either 1.4 or 1.5 million barrels per day added on this year to global oil consumption. That's the consensus. There are higher estimates on the supply side. We have the ongoing cuts by OPEC Plus. That's regular OPEC led by Saudi Arabia, along with the miscreants led by Russia. And they keep extending those cuts. They extended those through June. Now, more oil did come onto the market from Russia simply because Ukraine has been so busy blowing up Russian refineries that the Russians aren't able to process all of their oil into things like diesel and stuff. So they sold a bunch of that on the market. But the Russians just announced they're going to cut back their oil exports in order to bring themselves into line with the agreed upon cuts that they had with OPEC Plus. So that means some of that excess oil will be coming off the market. So you put these things together, and it's not like Ukraine lacks for drones. They'll probably be sending more to Russia, hitting them where it hurts. And I think we are going to have a good year for oil. That's something I've been actually saying since January. It's nice to see this thing pan out, and I think we'll see $90 oil this year. That isn't that far away now. It was like further when I started talking about this a month ago. But I mean, all the signs are there. It sure looks like an easy bet. We just have to see the outlook on Wall Street change toward oil equities, change toward metal equities, because right now they're still somewhat bearish on these things because they don't expect the rally in the underlying commodities to last. But the signal from the Fed is one of those things you look for to say, yeah, that's going to help. The underlying rally in hard assets will last. So I think it's a good time to be in all these sorts of things.
So, Sean, in all fairness, you look at some of the larger cap oil stocks, those are actually at all-time highs, or some of those ETFs are at all-time highs. But you compare that to the gold equities, not even the large caps are close to all-time highs. The small caps in both energy and precious metals, those have also been lagging. What changes this then? Is it simply an environment where everything keeps running and finally more money filters down to the smaller guys? Because there is a pretty wide discrepancy right now between the oil majors and oil juniors and all gold stocks.
That's it. You really put your finger on an important point, which is the big guys are performing just fine. It's the broader market for oil and especially for metals that's really underperforming. And so I'm making bullish bets that this will change. That doesn't mean it has to. I mean, Wall Street can go on ignoring me forever, and they often do. But I'm just looking at things, and I'm thinking that if you find the right small companies, and I'm not talking explorers now, that's a whole different thing, but the right small producers, I mean, they will either turn into cash flow machines or else they'll be scooped up by the larger companies which have the cash on hand anyway. We've already seen that in the oil industry. We've seen one merger or acquisition after another. I don't think that's over with either. I think there's plenty of room for more consolidation there as well. And so maybe that's what will happen is we'll get more and more mergers as like Wall Street realizes how cheap these things are. And if they're that cheap, then you either want to buy them or else if you're a big company, the big company wants to buy them. But I don't think they can stay that cheap for that long.
Yeah, Sean, it's nice to see some of the M&A in the oil patch, and hopefully we see a little bit more of that over in the metal space. You'd made an interesting comment to us before we started the call today, though, that it seems like a lot of investors, because they're ringing the register on the oil stocks today, even though it's bounced up over 80 and it's gotten to 81, 82, they're maybe not seeing that $90 price like you are. And it seems like the same thing's going on in the metal stocks where they can see that the metals ran higher in gold and silver and copper, but the stocks, even though they bounced a little bit, have also corrected where people are taking profits. Do you think it's something where the investors are just a little skittish and they just don't believe that these trends can keep going higher in the commodities and that they need to see more follow through before you get more momentum buying coming in?
That could be part of it. And I also think, just to touch on this again, Wall Street, or at least a portion of Wall Street, does not believe that the Fed is going to cut rates 3 times this year. They've had their hopes dashed over and over again. And at some point, Charlie gives up on the football that Lucy keeps holding out for him. But we just heard the Fed last week. They said they penciled in 3 rate cuts, and there are things around the edges of the economy. For instance, we're seeing, regionally speaking, we are seeing unemployment rise. I'm not saying alarmingly, but rise steadily month after month in some areas. And lower interest rates would help that out a lot because, for one thing, you could put more home builders back to work and like stuff like that. So I think that there's kind of a pessimistic outlook on Wall Street. We just have to get through that pessimism. But that's good for us in a way. If like me, you think this is what's going to happen, this gives you a chance to actually get in ahead of them. And so your hard work will be paid off, or else perhaps I should say your shrewd bets will be paid off. And that's what I think is going to happen. But it actually takes a change in attitude on Wall Street to bring this about. But how long can they ignore that the Fed has said it's going to cut rates? How long can they ignore the tremendous gold buying going on in China right now? I mean, I never want to count on the gold buying in China because it seems to come and go. That's for sure. But they are buying a lot of it right now. And this is having an effect on the global supply of available gold. So there are things at work here. And I think that things look bullish for both oil and gold this year.
Yeah, boy, oh boy, we've seen a lot of gold buying coming out of the East, and that really has been a key catalyst for these higher prices. But Sean, if you're saying the market's not believing these rate cuts that the Fed has even told us are on tap and coming this year, what's been powering the broad averages higher then?
Well, that's a good question. Part of that is due to the AI megatrend is what I call it, but it's actually part of a new tech supercycle. We've seen many tech supercycles before. We had one with like cell phones. Before that, we had one with personal computers. Before that, we had one with like transistors. We're seeing one with AI right now. And so it's going to change many, many things. It isn't just for making goofy pictures on the internet. It's used in many, many industries. For example, oil companies are using AI quite a lot right now because of its tremendous ability to process huge amounts of data. They can really narrow down where they should be drilling with incredible success. It's improving the success rate of like oil drilling by an order of magnitude. It's really, really good. It's not going to stop there. We'll also see it used in mining. We'll see it used all over the place. We're seeing AI used in medicine, not only making new drugs, but also used in like treatment of patients, stuff like that. It'll be used all over the place. It's a new tech supercycle, but AI is powering it, but it's not just that. It's also things like robotics. It's also, we're in a new upcycle for semiconductors, which are very cyclical. Well, we're in an upcycle for it now. And so that will power things along because everybody needs the brand new fancy chips in order to run AI. And so if you have AI running on these fancy chips, suddenly robots can do all sorts of things that they used to be able to do. And so now you can have robots doing stuff. They're using robots out in the oil fields more and more, by the way, because robots can do the dirty, dangerous work and not lose a hand or a foot that's really expensive and painful all around. Well, you don't have to worry about that as much when you have robots doing it. And there's a lot more to it. And I would say to people who do have a doom and gloom outlook on the world, and I understand that, sometimes I kind of wallow in pessimism too, just buy defense stocks. Defense spending is like cranking up like you wouldn't believe. I was watching a video on French defense spending, which, I mean, no one ever used to think about that. Their defense budgets after the Soviet Union fell, defense budgets across Europe just cratered. They went down because what wars were they ever going to have to fight? Of course, they didn't need that. Now that's all changed. Now you see Germany and Poland investing in troops and tanks. France is investing in building up its nuclear arsenal and also ships. Italy is building enough ships to make a real difference in the Mediterranean. There's defense spending all over the place, and not to keep beating this drum, but so much of it is powered by AI. because if you put AI on a drone or a tank or a submarine, suddenly it can do incredible things because it no longer has to protect people. And so that's another thing that's changing that market as well. So if you're doom and gloom just by defense, you probably do great. RTX is doing great in our Wealth Megatrends portfolio. But there's a lot of potential here. I do think part of the reason that is holding things back, part is seasonal. From last month through the month of March, tech usually pulls back anyway. It's just a cyclical thing. It just does. And so we are really getting to the end of that seasonal pullback. So we'll probably see that take off. But partly is because people have somehow, maybe because they watch too much TV news, I don't know, convinced themselves that things are much worse than they are. But I see a much brighter future for the economy, for investors, for corporations. There's some real potential there, and we'd be fools to ignore it.
Well, Sean, I appreciate that wild tour de force to the markets there. And I think that highlights one of your biggest strengths, which is you're able to look at megatrends before they happen and as they're playing out. And I wonder if you just take a quick moment and just let people know what you cover, because you have a couple different publications. You have the Wealth Megatrends, but you also have Supercycle Investor and Resource Trader. Could you just in a quick nutshell tell us what you provide subscribers that come and check out your work?
Sure. For my monthly newsletter, which is quite inexpensive, I think, and gets a nice big fat returns, that's Wealth Megatrends. That comes out every month. There's also a mid-month update. Then I have Supercycle Investor, which is really diving into AI with both hands. And that's doing quite well. We just took some nice gains in that. And then if you like resources, and I know it's been a tough time for resources, but that uranium bull market's coming back. Let me tell you, it's going to be great. We made a lot of money on it before. We're going to make more. The one for that is called Resource Trader. So I have three. I have Wealth Megatrends at the bottom, and then that feeds upward into Supercycle Investor and Resource Trader. And you can check all those out at weissratings.com.
All right, Sean, we'll post a link there for you. Thank you so much for taking time with us. Very interesting hearing kind of that optimism for a lot of different sectors. I like your comments there. If you are gloom and doom, go invest in defense. There's opportunities for that as well, but also understand that a lot of things are doing well right now, and sometimes it's best to not fight some of those trends when, especially, everyone else is making money in a wide range of sectors. Some of these sectors, though, hey, maybe they could start playing catch up, like some of those resource stocks. Sean, have a great rest of your week, man. Thank you.
Thank you.